One of the most common misconceptions we run into when meeting with prospects and clients is people thinking that they're saving into an IRA when it's a 401k, or thinking that their 401k is an IRA. So today we're going to spend a little bit of time talking about the differences between the two.
So the most commonly known retirement plan that you get through your employer is a 401k. That's typically what people think of. Those are employer-sponsored plans that you contribute to through your paycheck. There's a cap that you can do on them, $19,500 for this year. It does adjust typically year to year. And then your employer has the option to match a percentage of your income, or even maybe just do a flat match, whether you're contributing or not. It's normally very clearly explained to you in those documents when you first sign up for your 401k, what their contribution match is, and also what the vesting schedule is on it.
Mm-hmm. When it comes to an IRA, that's separate from your employer. That's an account that you set up for yourself, an individual retirement account. And it works much in the same way. It's a tax-deferred account, and you can contribute up to, right now, $6,000 a year before hitting the cap out there. And then as with the 401k, this also has a catch-up where you can contribute additional dollars once you hit the age 50. But works much in the same way, where you put in money and then you should see a deduction once it comes time to run your taxes. Another difference between the two is when you turn 72, there's a thing called an RMD, a required minimum distribution, you have to take from retirement accounts. Now with 401ks, if you are still working with that employer, when you hit 72, you do not have to start taking those RMDs. So that's where, kind of weighing the risk reward there of, should I roll my 401k over into an IRA if I plan to continue to work, kind of comes in hand. With an IRA, as soon as you hit 72, it doesn't matter if you're still working or not, you're going to have to take those distributions, which is going to be taxed to you as income.
Another big difference is you can take there's typically an availability to take a loan against a 401k. That's not something you can do on an IRA, so that is a differentiator as well. The other thing we wanted just to briefly explain was, one other question that we sometimes get is, how much should I be contributing to my 401k? What should I start it at? A good rule of thumb is, if you are receiving a match, at least do what you can to contribute to get the full match, because that's free money. If you think about it, that's free money from your employer that's matching all those dollars. So at minimum, do that. If you're not getting an employer match, we can help you back into what needs to be done. But another way to look at it is, do it until it hurts. Is that what you said?
Yeah, that's the best way to start trying to save, is if you can kind of stretch yourself a little bit, it's going to benefit you in the future. If you think about it, you're essentially saving today is buying a day in the future that you're not having to work. So if you want to see what that looks like to you, walk through your options of setting something up for yourself. We'd love to help you do that and walk through what that would look like. You can always reach out to us here at Next Step. We'd love to help you on your journey. Y'all have a good one.